All right, so you want to own a casino, or at the very least, you want to know what actually happens after you wire the money and take ownership? First of all, a modern casino resort can cost anywhere from 500 million to $3 billion. That's more than a commercial airliner. It's more than the GDP of some small island nations. But here's the strange part. The company operating the casino usually doesn't own it. And more importantly, how does owning a multi-billion-dollar gambling empire actually make you money? Because in the casino industry, ownership is a completely different business than operation, and it's far riskier than it looks. When people hear casino, they imagine slot machines and poker tables. But a modern casino resort is essentially a floating, self-sustaining industrial city. It consists of thousands of gaming machines, hundreds of table games, restaurants, hotels, entertainment venues, security systems, and surveillance networks all welded together into a complex designed to operate 24 hours a day, 7 days a week without stopping. And a massive infrastructure capable of handling millions of visitors annually, all built for an expected operational life of 30 to 50 years. A single property might employ over 3,000 people just to keep the wheels turning day and night. Let's take a large resort ordered from a major developer like Las Vegas Sands or MGM Resorts, but the prices are not random. It all depends on the price of construction materials at that time, the type of gaming license you want, the capacity of the property you want built, and the jurisdiction's specific requirements. And then there's global gambling demand, the ultimate wild card. Casino prices don't behave like real estate, they behave like volatile stocks. When gambling booms, then prices surge. During downturns, they collapse dramatically. For example, during the economic crisis of 2008, some casino values dropped more than 50% in a single year. Casinos that cost $2 billion to build were suddenly worth 800 million before they even opened, simply because demand evaporated overnight. In global gaming, there are three main players: the developers and builders, casino operators, and casino owners. And almost always they're completely separate companies. For example, a global operator like MGM Resorts, Las Vegas Sands, or Caesars Entertainment operates hundreds of properties. You see their logos painted on the side of the building, but they do not own all of those properties. In fact, many operators prefer to own as few as possible. Many are simply leased or operated under management contracts. So who holds the deed to that $2 billion piece of real estate? It might be a wealthy family office that has been accumulating gaming properties across generations. Families in Las Vegas and Macau control roughly 30% of the world's entire gaming real estate. It is a multi-generational art form of buying low and selling high. It could be a real estate investment trust where everyday citizens pool their money to buy a single casino property for tax benefits, or a Japanese leasing company, massive financial conglomerates that buy casinos purely as depreciation assets on their balance sheets, or even a private equity firm operating out of a sleek office in New York or Singapore. These owners don't care about the gaming experience. They don't care about customer service or entertainment quality. They just rent their properties. Owning a casino is basically a massive high-stakes leasing business. To make your money back, you have to lease it out. There are three main charter types, each with a vastly different risk profile. Number one is the management contract. It is a safe bet. The operator rents the property for a fixed percentage of revenue over a specific period. For example, 20% of gaming revenue plus 10% of hotel revenue for 10 years. So the owner provides the property, maintenance, insurance, and basic operations. The operator handles the gaming experience, customer service, marketing, and day-to-day management. If rates are high when you sign, you lock in strong guaranteed returns. But if the market surges right after you sign, you're stuck at the old rate. Number two is the lease agreement. The operator rents the entire property. They handle absolutely everything from hiring staff, buying insurance, maintaining the building, and managing all operations. For the owner, this is lower income, but almost zero involvement. Hand over the keys and wait for the monthly check. Then comes number three. That is the equity partnership. Owners and operators share profits directly, creating alignment but also exposure to operational failures. This is where owners make generational wealth. When a casino booms, profits skyrocket. When the Ever Given got stuck in the Suez Canal in 2021, halting global trade, tourism surged and casino revenues went parabolic. Properties that usually generated 200 million annually were suddenly generating 500 million. Owners became billionaires in a matter of months. But the hangover is brutal in 2023. As travel normalized and consumer spending slowed, many of those revenues fell by over 70%. How do these owners afford the casinos in the first place? It's because almost no one pays cash. The typical financial structure is 30% equity and 70% bank financing. Casino banks provide colossal loans secured by the property itself. To protect themselves, owners use a legal shield called a special purpose vehicle. If a magnate owns 10 casinos, they do not own them under one massive corporate umbrella. Instead, they create 10 separate shell companies, often registered in Delaware, Nevada, or other tax friendly jurisdictions. One company, one casino. Why? Because if a casino faces bankruptcy or legal issues, the rest of the portfolio is safe. But there's a massive problem lurking here. Let's say you borrow $1.4 billion to buy a $2 billion casino. A year later, the market crashes and the resale value drops to $1 billion. You're now underwater on your loan. The collateral is worth less than the debt. Bank panics and demands cash. If you can't pay, they seize the property. Casino history is littered with the corpses of over-leveraged companies. During the 2008 crisis, dozens of casino owners went bankrupt. Properties that were supposed to generate billions in profit became toxic assets overnight. Let's assume you manage the debt perfectly. You still face another enemy, regulations. A casino physically lasts 30 to 50 years, but regulatory rules are constantly changing. New gaming regulations, anti-money laundering requirements, responsible gambling mandates, and labor laws create sudden compliance costs. Furthermore, what happens if you build a casino today optimized for one demographic, only to find in 10 years that the market has shifted? Your property becomes a stranded asset. It's too expensive to operate profitably, impossible to sell, and its $2 billion value drops to $500 million. Its owners are constantly gambling on regulatory trends, consumer preferences, and geopolitics. Casinos face increasing pressure from environmental regulations, labor unions, and social responsibility mandates. Water usage restrictions, energy efficiency requirements, and community benefit agreements add millions in costs. Some jurisdictions are even considering gambling restrictions or taxation increases that could devastate profitability overnight. A single regulatory change can wipe out billions in property value. Because of this, casinos are traded just like volatile commodities. A property bought for $2 billion might be worth $2.5 billion in a boom because buyers want a casino today, or drop to $1.2 billion in a crash. Some owners don't even intend to operate the casino for its full lifespan. They speculate, buy low, operate high, sell high. And when a casino finally reaches the end of its operational life, it still holds value. The land itself is valuable, the building can be repurposed. The gaming license might be transferred, even in decline. A large casino property might yield hundreds of millions in land value or redevelopment potential. So why does this chaotic system work? For an operator like MGM Resorts, owning every property in their portfolio is incredibly capital intensive and debt loaded. If consumer spending slows, an operator with 50 owned casinos still has to pay 50 mortgages even if they're operating at losses. Leasing provides flexibility. If demand drops, the operator simply renegotiates terms or walks away. The operator stays lean. The owner takes the financial hit. This separation of ownership and operations spreads risk across the global financial system. When an operator goes bankrupt, the casinos don't disappear. The owners simply take them back and recharter them to a competitor. The companies may die, but the casino keeps operating. This separation creates a complex web of financial interdependencies where banks, owners, operators, and investors are all exposed to the same underlying risks. The interconnected nature of the gaming industry means that a crisis in one segment can cascade through the entire system with devastating consequences. For those who time the market correctly, casino ownership creates generational wealth. Buy during crashes when properties are undervalued, operate them through booms, and sell at peaks. Families that mastered this art control billions in gaming properties, but the margin for error is razor thin. One miscalculation, one regulatory change, one pandemic, and your entire empire collapses. Casino owners are constantly gambling on economic cycles, consumer spending, tourism trends, and geopolitics. A recession decimates gaming revenue. A pandemic shuts casinos entirely. A geopolitical crisis disrupts international travel. Wars, pandemics, and economic collapses are existential threats to casino profitability. The market rewards patience and heavily punishes overconfidence. The same principle applies to casino ownership with brutal precision. Owning a $2 billion casino isn't just renting a building. It means managing staggering debt, predicting macroeconomic cycles, betting on regulatory changes, navigating social pressures, and surviving brutal volatility. But when you multiply that across dozens of properties, leveraging debt, and reading the tides of consumer spending, you begin to understand how modern gaming empires are built. Not through control of the games themselves, but through the relentless calculation of risk at every level. Most successful casino owners aren't the ones who understand gaming. They're the ones who understand finance, leverage, market cycles, and how to position themselves to profit regardless of which direction the market moves. They're the ones who can survive the inevitable downturns and capitalize on the booms. They're the ones who understand that owning a casino is less about gambling and more about managing one of the most complex financial instruments in the modern economy. They read the economic data, anticipate regulatory shifts, and position their capital strategically across multiple properties to hedge their bets. Sophisticated casino owner views their portfolio like a chess grandmaster views the board, thinking 10 moves ahead, understanding that today's boom is tomorrow's crash, and that the key to surviving is maintaining optionality. They keep debt manageable. They diversify their properties across regions, and they always have an exit strategy because in the casino business, the only constant is change, and the only certainty is volatility. Real winners in casino ownership aren't the dreamers who think they'll get rich quick. They're the strategic thinkers who understand that a casino is just a vehicle for managing risk. They know that macroeconomic cycles are inevitable, that regulatory landscapes shift constantly, and that consumer preferences evolve over time. What they do is position themselves to profit from these inevitable transitions. They understand leverage not as a tool for greed, but as a necessary component of the financial machinery that powers global gaming. They comprehend that the separation between ownership and operation isn't a flaw in the system, but a feature that distributes risk across multiple parties. This means that when things go wrong, the losses are spread out rather than concentrated. And when things go right, the profits compound across their entire portfolio. The mathematics of casino ownership rewards those who think long-term, act decisively during opportunities, and maintain discipline during booms. Understanding the economics of owning a casino reveals something profound about modern capitalism itself. It shows us how massive capital projects are financed, how risk is distributed across global financial systems, and how fortunes are made through careful navigation of uncertainty. It demonstrates that true wealth isn't created through controlling the games or manipulating people, but through understanding the underlying forces that drive demand, supply, and value. If you want to dive deeper into understanding how to navigate complex systems and make strategic decisions about your capital and your life, check out the books and resources available through the links in the description. The principles of casino ownership extend far beyond gaming. They teach us about financial planning, risk management, and the importance of reading market signals before they become obvious to everyone else. So if you found this analysis valuable, and you want to learn more about how to understand complex financial systems, how to manage risk effectively, and how to think strategically about your future, I strongly encourage you to explore the resources in the description. Subscribe to the channel for more deep dives into the economics of industries that shape our world. Leave a comment if you have thoughts on casino ownership. Share this with someone who needs to understand how real wealth is built. And hit that notification bell so you never miss when we break down the next billion-dollar industry.